Good morning, everyone. Let's kick off. Welcome back to the 13th episode of our Equity Explorer series. I'm Karena, a global equity investment specialist at Fairtree, and I'll be moderating today's discussion. So, Equity Explorer was designed as a teach-in on key themes in equity markets, offering deeper insights into industries, companies, and trends shaping global investments. Our goal is ultimately to give you the tools to better understand the forces driving markets and to highlight potential opportunities. However, please do note that this is not financial advice and it does not represent a deep dive on our portfolios. And with that, I'm really excited to introduce today's discussion. So, software has come under some pressure as markets question sort of the durability of their business models in an AI driven world. And today we're going to explore that debate through the lens of two companies at the heart of it, Adobe and Salesforce. Please feel free to send through any questions during the prezo, and try to answer as many as possible at the end. With that, I'd like to introduce Thembinkosi, who will take us through today's deep dive. T, over to you.
Thank you, Karina, and a lovely morning greetings to everybody on the line. As Karina has mentioned, I'm Thembinkosi and largely cover software for the Fairtree Global Equity team. And today I've got a very action-packed very action-packed slide deck that'll cover Salesforce and Adobe, which are one of the two companies that I'll be using to compare and contrast what we're seeing broadly on the software side and what they're doing in the AI era. So, promise it will be a very fun, engaging prezo, and please follow along. So, what we have as an agenda, firstly, I'll start on defining what is software, where Salesforce fits in that bucket, and where Adobe also fits in that bucket. And then lastly, tying it up with the current news flow that we see on our day-to-day basis, and touching on the current learnings on AI in a software environment and the current era of the current software sentiment. So to kick things off, what is software? I have a very long snippet there, but essentially software is a collection of instructions, data, and programs that tell a computer's hardware how to operate and perform a specific task. As the intangible component of a computer system, it acts as the brain, allowing users to interact with the physical hardware through applications and system functions. It's quite worthy, but another way to actually look at it is there's two types of software. One is the system or infrastructure software. Think of this as your Android iOS system or your Apple iOS. So essentially, if I have a Samsung device, Samsung runs Android infrastructure software. And then if I have an Apple device or MacBook device, that device has an Apple operating system. So these systems are what actually enable me to run my Spotify, Pinterest, my Instagram applications on the phone and be able to also watch Netflix and YouTube videos. What the companies that I just mentioned now, the applications that I've mentioned now, that's application software. That is what sits on top of your infrastructure, your system software. Another way to explain this is you can update your phone's software or your system infrastructure software, and your Spotify will still look the same. But Spotify can individually update its own software, and then your Pinterest or your Meta or your Facebook account won't be impacted, but the mainframe or what you experience using the application gets different. So there are two buckets, and an easier way to think about system infrastructure software is your pipe, and then your application software is the brain. For the two companies that we're going to focusing on today, Salesforce largely plays in customer relationship management software, and that is within the application ecosystem, which is worth 508 billion and growing at 11%. They also do have certain things that are in your analytics and business intelligence software. So that's largely stuff that I've acquired to actually broaden their suite of products. And then Adobe also plays within large applications, but they also do have some application development stuff within their stack. And then when you actually look at these numbers, application is more than 50% of the software market. And then your pipe is closer to around 25, 30% of that pool. When you look at software and how is it built, it's largely on servers or on containers, whether this is on cloud-based servers or on-premise-based servers. So we've largely talked on this Equity Explorer series about the hyperscalers. So those guys actually have data centers, and the software is actually built to run on those data centers. How is it sold? There are three models. One is perpetual. If you go back 15, 12 years ago, when you needed to install your Microsoft Windows 7 or Windows 8 at the time, you needed to buy a physical disk, put it in your disk drive, and have it installed. Remember that you only paid once, so that's the perpetual licensing model. Then it moved 5, 10 years ago to subscription-based model, where Office 365 was introduced, and you started paying yearly subscriptions or monthly subscriptions for you to use your Office, PowerPoint, and Excel. It has then now morphed into another model, which is called consumption models. So that means if you don't use your Excel worksheet for the month of April, then Microsoft will then charge you for that usage. But if you use it, opening up 100 Excel worksheets, then Microsoft will charge you for working on those 100 Excel worksheets. And then another interesting stuff is what can software do? There's a plethora of stuff, but today we know that it can do predictive analytics, some machine learning stuff, iterative and logical reasoning, mathematical computations, and then in the generative artificial intelligence era, which we've largely started to see a sense of it in the last 2 years or so with ChatGPT and OpenAI and Anthropic introduced into the market. That is also further showing us the capability of what software is able to do. Then, in terms of the pricing models, when you actually were purchasing your Microsoft license 15 years ago under the perpetual licensing agreement, remember that as a customer, you handled how you customized it, you actually were purchasing it, and the management of that software was entirely on you, whether you had your antiviruses also plugged in into that. Now, the vendor, Microsoft, only needed to sell you and maintain it. Now, on a subscription and consumption level, that pricing model has changed where the customer is only responsible for purchasing of the software, but everything else is now the vendor's responsibility. It's either the vendor delivers the software on cloud or on premise or on premise. The management of the hardware, they need to update their servers, make sure that there's no downtime, and they also need to purchase their own hardware. So you as a customer, none of us are purchasing our own servers now. Those are now being run by the hyperscalers. So that's how the business model has shifted. And then there are some advantages and disadvantages of this. When you look at your perpetual licensing model, the advantages is you only paid upfront, perpetually, you buy once and then you forget. And then the maintenance was run by the company. But the disadvantage it is it's quite expensive because you pay a lot in the initial stage. And then for the software business, it's a very volatile revenue stream. So that's why they moved to cloud subscription model where the customer pays a very low amount, but they know that over a 3 year, 5 year, 10 year cycle, that customer, they will be paying a decent amount in terms of purchasing that software. And then it creates a very predictive revenue stream. What we've also observed, particularly in the US, in the mid 80s, a large amount of the software, say around a 55-45 split, was between third parties. So this is proprietary dedicated software companies generating software for all purpose use versus 45%, which is if Fairtree has its own proprietary software generation. But now the market has moved. If you actually now remember the dot-com era where there was a lot of the internet stage, and you started to see people do their introduction to the cloud, that you started to have a large part of third party share. People purchase software from other vendors that are actually quite leaders in those spaces, and you've actually seen that grow to just under 80%. When you look at software and how it actually comes through on the income statement or the financial aspect of it, or what the market largely looks at. One, think of it as water trickling into the bucket. Revenue becomes the output, but what the market largely looks at is deferred revenue or remaining performance obligations. So, what this is your total contracted value from your customers. A nice way to explain this is if 10 people on this call immediately sign a contract with Anthropic or Microsoft worth 100 Rand each. So that would be worth 1,000. That would be your remaining performance obligations. But that 1,000 Rand would need to be split over a 3-year period because we have entered into 3-year term agreement. So year one, they would recognize 333, year two, 333, year four, 333. So that's the revenue that would actually be coming through within that pot. Then this is just another example of a similar equation is if you've got 10 customers paying $100 each, you've got one customer that falls off that ecosystem. By the end of the year, you've got 9 customers that are paying you $10 each, which means your churn, you've largely lost 10% of the business. So that's why your cross retentions on the software as a service side across this list of companies is around 90%. But within now, when the salespeople at these software companies, they already know we've got 9 customers that are paying us $10 each. Let's upsell them or told them that we've actually updated a new function and also passed through inflationary increases that it gets to a point of like $30. So that means in a given year, these software businesses are able to absorb the $10 losses that they've made and also get new business of $30 from the existing customer base. And then that comes through as net retention rate. And the median across the bucket of software names is around 109%. Effectively, this means from your existing customer pool, software companies on a given day, on a given median percentage actually grow at 9% rate. And then from getting new customers into the mix, you can get $10 to $20, which then adds to that. So this is a nice thing about the business model is within your current cohort of customers, you can upsell them to a new product if you've got a plethora of products. So think of Microsoft, for example, anywhere from their cloud applications to Office, Microsoft Teams, etc., etc. So you're always being moved up the stack. Then a business to think of, which is the first one on the list, is Salesforce. When you look at the company background, founded in 1999 by Mark Benioff and Parker Harris, these are ex-Siebel and Oracle marketing guys. They're largely seen as the pioneers of the software as a service models. And some background, Mark Benioff worked for Siebel. Siebel largely sold their software in perpetual licenses, and he was part of the marketing department and he actually marketing and sales department, and he actually saw that there's a large amount of friction if you go lower into the market that the small SMBs are not able to purchase are not able to foot the high software cost. So that's actually why he flipped the business model to software as a service. And when you actually look at it, it's a market cap of 152 billion, non-GAAP PE of 13 times, and then GAAP PE of 21 times. The difference between these price to earnings multiple is largely stock-based compensation and amortization of intangibles. What Salesforce is, and I'd like to explain this in using Discovery as an example. So Discovery has got a banking department. It sells medical aids, life insurance, investments, car and home insurance. Then you've got their Vitality Rewards program. So if I'm Thembinkosi, Discovery would like me to be on all their products, they would have effectively been able to monetize me as their customer. So what do they use to actually get me to have all their platform customers is that actually use Salesforce system. So I might meet with a Discovery sales rep at the Willowbridge office, and that guy maybe sells me life insurance initially, and then I'm in their system. So from there, they do lead management. They start sending me emails about the nice medical aid options that they have that I maybe need to join their banking system or to get better terms on my life insurance. I need to be on a vitality program and then also join Virgin Active. So all those things they're able to do with their sales and services segment. And then platform and other is where they actually now start to build a dashboard and be able to communicate with their field service reps, their marketing department as to what stuff they need to post online, how they manage their adverts. Then it moves on to Journey Builder, where they actually track my progress in terms of when do I sign up for a new product on their system. All of this, they use data from how I interact with them on social media to how I interact with them on the call center. When I have an issue, they're able to resolve my stuff. Then the data segment is when they see the full analytics of my customer journey, and then it also moves to their thousands of customers. This is not their dashboard, but an illustration of a dashboard of what somebody under the Salesforce ecosystem would see. And this is largely a sales agent that is able to see within respective quarters how much they've able to make in terms of deals. Then that also transpires to how much they were able to get from web, so from the internet queries to phone inquiries, and also you can actually see that this is actually quite smaller in the mix. So this also gives the line manager an effective way that they can actually see where their sales rep are quite effective and where they're not effective, and actually make them told as to what they need to sell and how they need to sell it. Then, when you look at the Salesforce business, it's largely an acquisitive company. When you actually look at their existence since their founding in 1999, they've acquired more than 30 companies. And this is largely for them to build into their existing suite. So they started off as a sales management company, then they moved into service. So capturing the full life cycle of the customer. Then they've moved into analytics, commerce, how they deal with marketing. And that's largely them acquiring these certain amount of companies. The key one has been Slack, which is, think of it as a heavier version of Microsoft Teams that's largely used for internal departments, a lot of people in the developer space. So they acquired that business for 27 billion in 2021 at 23 times enterprise value to sales. So the business was generating 1.2 billion at that time, and they paid 27 billion. And a large amount of that was in stock. So they issued stock to make that acquisition. When you look at it as where we are now by FY26, by our estimate, we roughly would pen 35% of their revenue has come from the acquisitions that they've made in the last 20 years. And then the other 65% is from organic. And the way that they think about mergers and acquisitions, it's either you're acquiring the tech and the talent, so the IP that you get, or you're going into adjacencies, so a complementary product, or strategic, where you're now venturing into a completely different market. When you look at their customer base, it's quite astonishing that 20% of their customers use more than four products. And of these 20% customers that are on four products or more actually account for 85% of their annualized recurring revenue. So this is just to show us that the further they move you up the stack and they actually upsell to you, the more valuable you become as a customer for them. And then in terms of their growth algorithm, 80% of their growth comes from their existing customer base, and then the other 20% comes from expansion. So this is new customers coming into their business. It's largely done a significant amount of growth when you look at like revenue. From 2011, where they were doing just under less than 2 billion, to now where they're doing more than 41 billion worth of sales. And for the next 4 years, they're guiding to hit 63 billion, of which would imply a 10% CAGR. In the AI era, they're largely talking to implementing agents. So if we go back to a discovery example, if I now have an issue with my vitality rewards, or I need to have a claim on my car insurance, I'd call the call center, and not a physical human being would actually answer, but an agent would actually step in and have that resolution. Now, this would be something which is programmed around the discovery ecosystem. And if that agent if I start asking the agent something which is above its sphere, then it will redirect me to a human way to actually step in. So they have that through customer service. They also have a sales coaching agent where it would actually teach a new employee at discovery as to how to sell its products, etc., etc. Their cost base, which has largely been a quite topical thing, is on a gross profit margin that's largely flattish around 75, 77%. The key thing to notice is in the last 4 years, they had a very big strategic tilt under their then CFO, Amy Weaver, where as revenue slowed down, Salesforce looked to actually manage its cost base. And the one key thing that they did was managed its sales and marketing. They was in 2021, they were spending more than 45% of their sales in sales and marketing, and now that's dropped to 34.5%. This has come with them laying off more than 10% of their employees and also using AI to better sell. In certain occasions, they would go and have maybe 10 people to go and speak to a client to close one deal or sell one product. They've massively rationalize that down to 2 to 3 employees just to effectively better sell. And also, those 2 to 3 employees are now going to sell 2 to 3 products. So that's where the efficiencies are coming through. And we're largely seeing the operating profit margins come from 3% in 2023 to just under 21% in 2025. So they've massively been able to get that operational leverage in the business. Another topical thing is the difference between GAAP metrics and non-GAAP metrics. When you cover a software business, they largely talk to the glossier non-GAAP metrics that actually show margins at quite higher levels. But the one key caveat here is you've got stock-based compensation that these companies don't treat as a cash-based expense, and you also have amortization of intangibles, where now GAAP actually treats all those costs as expenses, and you can actually see that the margin is quite lower, where you've got a gap of around 10%. But nonetheless, as I've talked to the operational leverage that the business has seen in the last slide, their margins are now at 21%. And based on the inferred guidance by FY30, that should get to around 27%. And then this just also shows you why there's a difference between GAAP PE and non-GAAP PE. And that's largely your stock-based compensation and amortization of intangibles. Share count, largely close to doubling from 2011 to 2021. And that's because they've largely have a big stock-based compensation expense, and also the acquisitions that they've made, they've also included an equity component in those deals. Then free cash flow. They are a business that generates cash flow from operations, but that largely gets offset by the mergers and acquisitions that they make, the stock-based compensation that you see, and in certain years, they do have a working capital drag, but this is largely due to timing as to when they receive payments from their customers and how they also pay their supplies. And then after cash flow that they've generated, we're seeing a slight improvement in the last 3 to 4 years. That free cash flow that they've generated have ticked up, and a large amount of that free cash flow is that they're using buybacks to actually manage that stock-based compensation dilution. And you do have a few deals also come through. Then their stock-based compensation topped out around 10, 11% in the recent 5, 7 years, and that's largely dropped to 8 to 9% in the last 3, 4 years. But on an absolute level, they're paying just under 3.5 billion worth of stock-based compensation. And a large part of that is going into your sales and marketing departments, the people that actually go out and sell the software, and also within your research and development, the guys that actually develop the products that you then get to sell. Then second company on the deck is Adobe. They're largely older than Salesforce, founded in 1982. And literally in its founding, it was the then CEO that wanted to have a standardized format for when you're printing a document. So that's how the Adobe software was actually brought into use. Then they're largely known for Photoshop and Illustrator, which were created in 1987 and 1990. So those are the flagship applications across more than 20 plus that they have. And these are largely used by graphic designers, everybody, and everybody that's large in the creative space. Acrobat Reader, which we largely used as analysts and also people that might deal with clients with the amount of documents that we get inundated with on a day-to-day basis. So that was largely launched in 2003. It's largely on a freemium option. Like if we were to do a poll now as to how many people pay for the Acrobat or PDF Reader, I would be surprised if that's like under more than 5%. So that's just to show is like it's mostly a freemium model. And then they changed their business model to subscription, where it was largely perpetual before 2013, 2014. And that was also picking up on the shift to the cloud. It's at a market cap of 90 billion, non-GAAP PE of 10.5 times, and then GAAP PE of 13 times. They've also got stock-based compensation and amortization of intangibles in their financials. Then who uses the applications? I might have alluded to this a bit earlier on, but they largely categorize their customer subgroups into three. One is business professionals and consumers. These are guys that are largely using Adobe Acrobat Reader. So, reading documents, signing the documents, largely freemium, but you do have large corporates. Imagine a bank in the Discovery example where they deal with a lot of documents. They need to be signed. They need to be stored in their own different cloud. So they would largely pay for that service. Then you've got something called Adobe Express. This largely competes with Canva. And what is actually quite interesting here is that it's a new product to capture your casual student, teacher, personal use cases like people that do travel documents, invitations, and announcements. So the guy that wants to generate postcards, and then you've got business professionals, which is social media teams, sales reps, HR teams, communication teams, and small business owners. So that's more casual. Then you've got your hardcore customers, which is creative professionals and creators, and your marketing professionals. So that's all the way from your graphic designers, brand managers, your social media influencers. So think Mr. Beast and his team behind him that does the editing of the videos, and you also got gig workers. So your professional customers are more than 75% of your business, and then your entry level customers around 30% of your business. And when you actually look at that growth, your entry level or freelance guys are largely growing faster, though the pace is actually coming down. But when you actually look at Q4 to Q1, you're starting to see a re-acceleration in terms of that top line. Then these are three. Okay, let's see. So here I've got three illustrations, and largely what they talk to is one, you can use Adobe software to actually make an advert. Second one, you can actually use Adobe software to make edits where in terms of like when you creating content. So this is a guy that was actually using a guitar to actually make the guitar image itself to actually write the name music. then I'm struggling to get this one play, but it's just actually a lady that is a designer and wants to actually do wedding invitations. So that's a general use case of the Adobe software. And how it is, you actually have more than 65% of your customers on a bundled offering, actually using more than one application, and then the other 35 to 40% on single applications. Your individual licenses, half of the business is by individual licenses, and then the other half is enterprise term license agreement. So this big corporates where you have a large amount of seats or a large amount of people that use the software, and then team is relatively between your individuals and your enterprises, and those also use that software. Then they do have a funnel where you have freemium. So it's either you use all that stuff for free. Then once you maybe have edited 10 to 20 pictures and on Adobe Express, Adobe then upsells you to actually pay $5 to $15 a month. And then you can actually see how they move you through that funnel. And then you get to the upsell programs where you can get an Adobe Stock, Frame.io, or Acrobat Sign, depending on the size of the business. They are in a space where they largely were the incumbent. You now have had Canva and Figma come into the space, which are now doing 4 billion and 1 billion respectively, and growing 92 and growing quite faster than your Adobe, but Adobe is at higher revenue when you actually look at your creative software applications. What I actually want to draw attention to us here is when you look at Adobe paid users, they're at 41 million and Canva's at 31, where Canva has been able to see a very nice growth in that mix in terms of the amount of paid users. But when you look at the conversion between paid and your total users, Adobe is at 5%, Canva high at 12, and then Figma is at 4%. So this gives me a conclusion to two things. There's a large amount of people that are on freemium, and there's also a large amount of products on the market that are free. And then when you look at Adobe, they've largely done bundling to actually maintain their prices. And then with Canva, they've been able to also not only grow the amount of people that are using their products, but they've been able to grow the amount that they charge their customers. But has largely inflected downwards from 2022 to 2025 because they made the Affinity acquisition. Then on the Adobe level, what they're actually doing now in the AI era is one, they have their own proprietary AI generation models, which they call IP safe, is that they're not going to use stuff that they might find from Disney. So with Adobe, you can't create Mickey Mouse or Donald Duck, but and then they also have partner models. So that is Google Gemini with the Nano Banana, ChatGPT, and also Anthropic. So they largely want to keep you within their applications, and then you use third-party models where there is a revenue sharing agreement, or if you use Firefly and other of their proprietary models, you largely stay within that platform. What is also another interesting observation is they now heavily discounting their software. So when you actually look at 3, 4 years ago, it was largely 20 to 25% discounts for their licenses. Now it's around 40%. When you look at revenue profile, 2013, 2014 is where they went through that massive shift of moving from perpetual licenses to subscription as a service model. Your recurring revenue at this point was around 30%. Now we are around 96% of their revenue is recurring. So that is under subscription as a service model. And largely in the last 5 years, the business has been maintaining a 10% growth. They are now off a higher base, so you would also expect that the growth to actually come down. Then their cost base relatively different to the Salesforce one. They had 90% gross profit margins. They've also gotten some operational leverage coming from their sales and marketing that have dropped from 36.35% in 2015, and now it's at 27.3%, to actually see that their operating margins have gone closer to around 37% from 2013, 2014, when they were going through that massive restructuring process. Then they also market largely looks at non-GAAP margins at 47, 46%. We typically like market looks at the non-GAAP margins. We like the GAAP margins, which are relatively at 37% versus 46. And then the earnings, which also explains GAAP margins at GAAP PE multiple at 13 versus non-GAAP at around 11. Then their share count, what Adobe has been able to do in the last 15, 16 years is been able to reduce their share count by 20% because they've largely been doing buybacks in that very same time period to actually manage the stock-based compensation that you'd see. Then free cash flow, nice steady free cash flow generator, close to 7 times free cash flow yield, or even if when you've stripped out the stock-based compensation. And then the graph here is just to show you that in the last 4 or 5 years, the amount of free cash flow that they're generating is largely going towards buying back their stock. And it's been quite aggressive in the last 2 years, where the share price has been quite battered a bit. Software businesses are quite acquisitive. You can also see that with Adobe, not they don't pay as much as Salesforce, but you actually look at it as that in the last from 2013 till now, they've largely paid 13 billion for acquisitions. That's largely 3.4 billion worth of revenue, which is a 15% contribution. The one caveat to this is in 2022, they tried to acquire Figma at 20 billion, which was more than an 80% premium to what it was trading at as a private business. Then it was doing 400 million worth of revenue and was going to be at 50 times EV to sales. Now we know that the business is doing 1 billion and 50 and some change. It would have contributed 4% to Adobe's revenue, but because of regulatory issues, the acquisition fell through, and Adobe had to pay Figma a 1 billion break fee to actually increase its arsenal to actually develop more products to actually compete with Adobe. Then their stock-based compensation largely accelerated in 2016 to 2025, but on an absolute, as a percentage of sales, it's relatively just under 8%, and they're largely paying half of that to the guys that are in your research and development departments, and then also the other is spread across your sales and marketing, general and admin, and the guys that actually manage your cost of goods sold. Then, lastly, on the Adobe side, is it's for customers that are actually on Adobe plans, is that they've largely communicated that it's quite difficult to exit the Adobe contracts because there's a lot of hidden terms and conditions and penalty payments. So they've largely taken them to court. And as of March 13, 2026, you've had the regulator actually slap them with a 150 million fine, which they actually settled, where half of it they actually slapped them with 150 million settlement, where they're saying that they're actually violating the Shoppers Confidence Act. So that might also cause less friction moving forward when customers actually want to exit their license agreement. And then the last segment is where are we at now with the AI theme? And it's important that I begin here where if I go back to 2021, the market was down 30% across the board. Then late November, we had the introduction of ChatGPT, and that actually sparked some market enthusiasm where you started to see what AI could do in that period. And then subsequently, you started to see these companies run up quite nicely at more than 70 to 80% share price return in the space of 15 to 16 months, all the way going up to your late 2024. Beginning, so late 2024, going into 2025, the narrative started to shift in the market where these businesses moved away from being AI beneficiaries to being disrupted by AI. So that's where the narrative started to shift. And one, the market was now calling for these companies to actually have more products, which is actually leaning into AI and the adoption of AI. But you also had the new competing guys, Anthropic, OpenAI, calling for software is dead. They started to release stuff that the market perceive is competing with these AI names. You also have another underlying theme where your semiconductor stocks that actually provide the picks and shovel for softwares actually do significantly quite well in this time period, but your software names have been battered. You look at your Adobe, that's down from when you look at their share prices down more than 60% when you rebase it to January of 2022. Everything looks underwater except for your SAP, but that's largely come late into the party where the market has largely also looked at their ERP business, which is quite seen as defensive in the AI era. Another key thing is on software employment, you largely see it as there has been a slowdown in hiring, but there hasn't been a drastic decline in terms of the amount of people that are still employed in terms of employed in the software space. So that's also things that we're monitoring because the one key thing is with AI, it replaces the amount of people that you need to actually do your developer functions or actually program that software. And then another school of thought is it actually adds in terms of the productivity. So you don't need to hire more developers or more coders. The AI can take that function. And then we're also observing another mismatch is that when you look at the software and services index, is like it's actually down when you actually look at it on a share price perspective, but the earnings revisions have largely held up. So it's not, and this is where the market is actually looking at the terminal value or the terminal value of the free cash flows that these businesses might earn, where they actually see it as heavily under risk versus the short term and near term earnings potential. So, a large part of the market is rebasing the terminal value of the software names. Then, another key thing that we're also observing is the narrative has done well to say software is dead when the revenues are declining, but we're now starting to see in the last quarter or two, Adobe, Salesforce, as a notable few to actually show that revenue is accelerating and they're also now starting to recognize software related revenue. Then sentiment wise, Sam Altman, head of OpenAI, he had a tweet to say, entering the fast fashion era of software. It had a lot of engagement on Twitter. That also led to a market bloodbath. Citrini report. That also had a lot of engagements, doom and gloom in terms of the software sector and also in food and delivery. That also led to another market bloodbath. Then we built a Monday.com clone in under an hour with AI. So this has largely been something that people talked about vibe coding, the ease in which people can also develop their own software. So this has been the bearish argument. And then the bullish argument is from CEOs and also Larry Ellison from Oracle and some CEOs, notably from Workday, to say that software is not dead. Software is not dead, and you're also seeing AI being a significant mention in earnings calls. So you can actually see from 2022, it's significantly wrapped up that it's now being a noticeable topic on the earnings calls. And then another key thing to observe is when you look at OpenAI and Anthropic as a business themselves, is they're largely combined have surpassed Datadog, Workday, ServiceNow, Adobe, Salesforce, and they're now closing in on Oracle and SAP on a revenue generation base, where they now have topped more than 45 billion in February of the combined revenue that those businesses are growing. And they're quite growing fast, which is also to show you that the wallets are shifting. Some of it is going into AI, some of it is still remaining on the software side. Then, second last slide, when you look at your incumbent software players, the one key thing to note from this chart is everybody is also transitioning to AI, but when you actually look at the amount of business that they have, which is AI facing, software is only recognizing 540 million, which is 1% of their revenue, which is tied to AI, but that is growing within their mix. You also see that across other several software companies. Then, in closing, this is just a market observation or what we're actually observing on a global perspective. And when there has been significant shifts in terms of disruption in a particular sector, the first example is on the automotive space, largely in passenger vehicles. We know from the year 2000s, GM, Ford, Toyota, Volkswagen, and Daimler were the top five OEMs. Now, Toyota, VW, Hyundai's got into that list. GM is fourth, dropped to fourth. Then you've got Stellantis, which is coming from a big merger from Chrysler, Peugeot, and Fiat. But what is quite interesting to observe within this chart, you've had four Chinese entrants that are more than 15 million of the units in the top five, where your PV sales are 91 million. So they're largely taking share because they're also growing in China. But that share that they're taking is fundamentally driven by that your powertrains have shifted. You now have moved from 100% ICE vehicles or internal combustion. You now have BEV penetration that has moved from 0 to 18 to 15%, and PHEV penetration that has moved from 0 to 8%. So you do have certain players that do take share when there is a tilt, but largely you still do have the incumbents that still remain. Toyota, VW, Hyundai, their mix is 90% ICE, and then the other 10% across the three, you do have some plug-in hybrids and some BEV. So they're also shifting within their powertrains. Another example is within US retail, where e-commerce penetration has largely moved from less than 1% in the year 2000 to more than 80%, 18% in 2025. When you look at it on a dollar basis, it's moved from being a market worth 3 trillion to 7.8 trillion. Your top 15 share market has moved from 16 to 34. But when you look at the number one player, it's remained Walmart. Sears and Kmart are displaced by Amazon, which is your pure play e-commerce retailer. But when you look at this list, you do have the names in blue where Selfie and Albertson actually merged to form Albertson Co's, but you largely have four or five names that actually fallen off the list, but it's relatively still the same amount of companies. But they've also internally grown in terms of revenue and also shifted to e-commerce where a plethora of them have more than 15 to 20% of their sales coming from e-commerce. So a market does shift, you do get a disruptor, but the incumbents don't just sit and say, hey, come take our market share. So in closing, that's my final take on this presentation. And Karina, I'm happy to take questions. Thank you everyone for listening to my presentation.
Fantastic. Thank you so much, T. That was a really interesting presentation and really interesting space. We've got some questions that have come through, so maybe I'll kick off. You just wrapped up the presentation showing the divergence between semiconductors and software names. Do you think these shares are being priced like losers is a fair assessment or not?
That's quite an interesting question, and it goes back to the definition that I had earlier on is Software sits on top of hardware. So if you're massively building the hardware, you still need to have an application for it. So it depends as to how you then allocate your dollar, your software dollars. Are you paying everything to Anthropic? Are you not gonna need developers anymore? So that's the first thing. But largely, I think to your question, the market is largely drilling in on terminal value. So there's a lot of unknowns now to say, will Salesforce exist in the next 10 years? Or will a part of Salesforce exist in the next 10 years? If a person can vibe code CRM, a customer relationship management software, it's largely within the trust layer. If it's a mom and pop shop of 4 to 5 people, yes, they can do that, then they don't need a Salesforce. But now, if it's discovery, where you need to change 20 years worth of system integrated infrastructure, then it becomes a regulatory issue, it becomes a compliance issue. There's just a lot of things. But to your point, there is a year in your answer where there is a shift, and people are attributing a large part of the value to the hardware names because they can actually have foresight, or they do have a see through into the next 3 years what the free cash flow profile will be. But on the software side, people are actually questioning is in the next 5 years, will this business exist or not? So that's largely where the market disconnect is. That's why you're seeing the hardware names actually rally quite hard, where the software, there's a lot of pockets where the market is starting to actually place a lot of questions.
Fantastic, thank you. And then maybe just pivoting off of that, the next question would just be on, does software get replaced in this sort of day and age?
Um, so I listen to a lot of the software CEOs, and they largely say AI is software. And this also touches on the premise where people just think software is the code, but software is a learned experience. If you wanted to check out the enterprise resource planning of ShopRite, which is largely built over the last 20 years, and you say you want to vibe code everything. How ShopRite communicates with AVI, communicates with RCR in terms of their purchasing, how they communicate with their 60/60 product. That has a large amount of data, muscle memory, actually planning out your routes and all those things. Yes, AI can be embedded within the ShowPage software layer, but completely cutting it out, you can actually see how SPA has actually failed in terms of the implementation. Then ShopRite has actually perfected its implementation. Now imagine you've gone through 3 to 5 years implementing the stuff, you've got 20 years of knowledge, and you want to give it to Thembinkosi to actually recut the system and be like that one employee where I could fall sick and then everything else that I knew about the software is gone. So there is that risk that the software that companies are actually placing on this. And then secondly, ShopRite has a set budget for how much it's going to pay for software. They know about it. With AI, a large part of it is consumption based. So you could easily spend 3 years worth of your budget within 1 month if a person is quite trigger happy with their tokens.
No, fantastic. Thank you, T. And thank you for the really insightful presentation and the answers and all of that. It's been really great to have you on today. If there are any sort of further questions from the audience, please feel free to send them through to myself or T or anyone in the team, and we'll be happy to address those. And yeah, to the audience, thank you again for joining. We're really looking forward to seeing you again at our next session, which would be on the 14th of May. We'll be delving into the online travel agencies, specifically bookings and trip.com. So yeah, let me cut it off at that and see you then. Thank you so much, T.
Thank you, Karina, and thank you to everybody on the line. I enjoyed presenting to all of you today.
Fantastic. Bye bye, everyone.